Understanding metrics, a comprehensive overview. Metrics are the lifeblood of any data-driven organization. They serve as quantitative assessments that allow businesses, analysts, and executives to gauge performance, compare results, and track production over time. This article delves into the diverse world of metrics, their applications, and best practices for choosing and using them effectively. What are metrics? At their core, metrics are defined as measures of quantitative assessment. They can encompass a wide range of data points generated from various methodologies designed to evaluate performance or production. Metrics play a crucial role in decision-making for businesses and organizations, forming the foundation for performance assessments, strategic reviews, and investment recommendations. Historical context. Metrics have a long history, finding applications across various industries such as accounting, operations, and performance analysis. Over time, the concept has evolved, with industries establishing their own standards and methods for benchmarking and evaluation. Nowadays, metrics are an integral part of corporate finance, operational strategies, and project management, representing an essential component in both internal analysis and external reporting. The function of metrics in decision-making. Roles of metrics in various fields. 1. Executives. They rely on metrics to analyze corporate finance and operational strategies. These metrics include financial ratios, revenue growth, and cost management indicators, which influence overall business health. 2. Analysts. They utilize metrics to form opinions and provide investment recommendations based on industry performance and comparative analyses. 3. Portfolio managers. Metrics are vital for managing investment portfolios, navigating asset allocations, and ensuring alignment with investment strategies. 4th, project managers. In project management, metrics are crucial for tracking project progress, ensuring quality control, and enhancing team accountability. Choosing the right metrics. With an abundance of data sources available, selecting the most relevant metrics can be challenging. Key considerations include: 1. Defining goals. Establish clear objectives that the chosen metrics should support. Identifying what you want to achieve is the first step toward effective metric selection. 2. Identifying relevant outputs. Focus on the outputs that align closely with your goals. This could involve understanding the operational processes, financial performance, or market dynamics that impact your business. 3. Setting targets. Establish achievable benchmarks for each metric, integrating them with business decisions. These targets will serve as points of reference for assessment and analysis. Academics and corporate researchers have developed frameworks and methodologies to streamline this process. For example, applied information economics, championed by Douglas Hubbard, equips managers with the tools to make informed decisions based on the metrics analyzed. Prominent methodologies and models. Industry standards and notable examples. Several organizations have created metrics that have become industry standards. DuPont analysis. Developed by DuPont, this analysis method isolates variables that impact the return on equity, ROE, metric, helping businesses to understand their financial performance better. Six Sigma. Originally pioneered by General Electric, GE, this set of quality management metrics focuses on process improvement across 6 key areas, critical to quality, defects, process capability, variation, stable operations, and design for Six Sigma. Categories of metrics. Metrics can be broadly categorized into various types, reflecting their specific use cases in assessing different aspects of business operations. Economic metrics. Gross domestic product, GDP, measures the total economic output of a country, reflecting its economic health. Inflation rate tracks the rate at which the general level of prices for goods and services rises, indicating purchasing power erosion. Unemployment rate represents the percentage of the labor force that is without work but actively seeking employment. Operational company metrics. Operational metrics provide insight into a company's performance through financial statement analyses. Key operational metrics include sales, total revenue generated by a company. Earnings before interest and tax, EBIT, an indicator of a company's profitability from operations. Net income, the total profit of a company after all expenses and taxes are deducted. Margins, efficiency ratios and liquidity ratios, these metrics provide insights into profitability, operational success, and financial stability, respectively. Portfolio management metrics. Portfolio managers analyze various metrics to make informed decisions regarding asset allocation and investment strategies. Metrics here might include environmental, social, and governance (ESG) criteria, a set of standards for a company's business practices that socially conscious investors utilize to screen potential investments. Project management metrics. In the realm of project management, metrics are used to evaluate project progression and success. Common project management metrics include resource allocation, analyzing the efficiency of resource use throughout a project. Cost and time tracking, evaluating financial expenditures and time management regarding project completion. Quality and safety metrics, ensuring that projects meet quality benchmarks and adhere to safety regulations. Conclusion. Metrics are essential tools that inform decision-making across various sectors. Whether in corporate finance, project management, or portfolio analysis, the ability to choose, analyze, and act upon relevant metrics defines business agility and strategic focus. By understanding the utility of metrics and employing them effectively, organizations can not only measure their performance but also enhance their overall operations. As businesses continue to navigate a rapidly changing landscape, a strong grasp of metrics is more vital than ever.